Okay, I'm going to go over the exam in a video so that you can replay it, you can skip the parts you don't care about, and that you understand, and so that you can go back and look at it more if you don't understand it, as opposed to having me fly by during class. So let's get to it, because there's going to be quite a few problems, right? If you look at $2,500 today, compounds annually, how much are you going to have in 10 years? Anytime you see how much will you have, we're talking future value. So future value of 0.0475 decimals, 10 years, simple 10 years, compounded annually, no payment, and I put in $2,500. Oh, I got a negative. Why did I get a negative? Well, because what I should do is put in, when I talk about putting in money, I want to put a negative in here. And then I get this out. Alternatively, you could have put a negative in right after the equal sign, but I prefer to keep the other convention. And I'll put a space in here so you see that. Okay? These answers, by the way, should be in your sheet that I sent back to you if you got it wrong. Present value of $10,000 in the future. All right, well, think about the present value function, right? As the number of years increases, well, that means you're pushing that $10,000 out in the future worth less. It's never going to be larger than $10,000, right? Because you have to discount it. Increases as the required rate of return. Decreases. So if I require a smaller and smaller rate of return, my present value goes up. You can think of that also think of this as like inflation. If inflation goes down, that money out in the future is worth more. So C is the right answer. Some of you put a capital C. I gave you credit for that, if you'll notice at the bottom of the exam. The discount rate required, if the discount rate is 0, which of these is true? Well, think about it. First of all, you can think about the one equation that we did, right? We did the present value is equal to the future value divided by 1 plus the required rate of return. Well, if that's 0, that's an equal, should be an equal sign. If the R is 0, if my required rate of return is 0, it's the present value is equal to the future value divided by 1. Present value and the future value are equal. It's just, or just intuitively, if you understand this, when you think about it, if I don't discount it all, then the money in the future is worth the same amount today. So the answer here is C. All right, let's try this one. If you deposit, make that highlighted so you can find it. If you deposit $20,000 in an account earning 8% annually, annual again, all right, so I don't have to worry about those stinking number of period things. What constant amount could you withdraw each year and have nothing remaining at the end of 5 years? How much could I withdraw each year? Well, that sounds like a payment problem to me. Payment problem. The rate, 0.08%. Number of periods, 5 years. Present value, all right? I put in $20,000, so minus 20. And in the future, I got nothing. So how much can I get out? $5,009.13. Now, I'm not doing the round functions. You can just surround these with the round functions to get what you would put in your answer sheets. So, again, if you just remember, if you can start off remembering what question you're answering, am I getting the payment, the present value, whatever, you're already partway there. Okay, you deposit $500 in a savings account today. Okay, that's going to be negative $500 someplace. 6% interest semi-annually. Ouch. 2 times a year. What will the investment be worth in 2 years? All right, worth in 2 years. Now I'm looking at a future value problem. Equals the future value, the rate. I'm going to think now in 6-month periods. So this is a 6% annual rate. So I'm going to use 0.06 divided by 2. Anytime you get these problems, always think that the rate, the number of periods, and potentially the payments are going to change. Right. So number of periods is 2 times 2, because times 2. I get 4 6-month periods. And my payment, nothing. I'm not putting any money in annually, but I do put in $500 today. All right. And what do I get? $562.75. Okay. All right. I'm going to keep moving because you can always go back and play these again and listen to it. If you have questions on any of these that didn't make sense, send me email, ask on conference calls, but ask. Make sure you understand these. All right. Katie deposits $1,000 into a bank paying 8% annually. How many years, number of periods will it take to have 25,000, sorry. All right, it's a number of period problem. Number of periods, what's my rate? 0.08, always use decimals. All right, sheet payment. No payments. Payment again is annual, or on whatever the period happens to be. She just put it in right now. So she put in present value of minus 1,000. And she wants out 25,000. Right? Put the negative for what she puts in. She's going to get out this. And we're talking 41 years. Well, that's a little while. Almost 49 years. Okay. Now, again, if you're compounding, let's take this compound. If you compound quarterly, 4 times a year, for 20 years at 8%, what are you going to use in your calculations? Right? Well, think 20 years, 4 times a year. That's 80 periods. You already know the answer is D. You already know. And we have to divide the rate by 4, which gives me 2%. So don't forget, you're going to affect the number of periods, the rate, and potentially the payments. So we have here a D. If you invest funds today, which of the following would be true? All right, so I'm putting money in. If the rate goes down, does the future value go up? No, if I get less money in the bank, If I get less interest, I'm going to have less money in the future. If the number of times it's compounded increases, the future value will decline. No. Right? The more I can earn interest, the more that interest compounds, the more that grows, the more my future value will grow. If the rate of return increases, the future value will increase. That's kind of hopefully the obvious choice. All right. Okay, this mortgage problem. We worked mortgage problems in prior class in the review, but let's do it again. All right. How big a mortgage can you afford? That's money I would get today. How big is the mortgage? So it equals the present value of, what's my mortgage rate? 5%. Time to stop. Right? Multi-periods, monthly payments. So that's my annual rate. I have to divide it by 12. Number of periods, it's 30 years times 12. That's how many months. My payment, I can pay negative 2250. Okay. So again, remember what you're doing is you have to change the rate. Oops, what happened in here? I got rid of the rate. 0.05 divided by 12. Number of periods goes up. Payment is, I don't have to change the payment because it is already in monthly payments. And now I can get a mortgage of $419,000. Now, I think Adam asked, what would I do with it if I had down payments and stuff? If I could put a $100,000 down payment, then the size of my house that I could afford would be $519,000. So the down payment just gets added to the amount of the mortgage that I could take out. What would you pay for $12,500 to receive 10 years from today? What would you pay? That means, what would I pay now? That's a present value. What's the present value of? Now, I'm going to come back probably and put a negative sign in here because I would pay it out. But we'll do it without the negative sign first. Discount rate 0.08. Number of periods, 10. Payment, 0. 12, 500. 500. I'm going to get that. So I'll do it this way. You'll see my number will come out negative. So I probably want to, in this one, put a negative sign in front of the present value just to make it look right. All right, you'll notice the negative sign here in front of the present value. I had to do that because this was positive and it gave me a negative number today. But I'm thinking of paying in a positive sense. If you're talking to somebody, you're not going to say, oh, I'm going to pay negative something. So I put that there. You could have easily put the negative in front of here, but I didn't. One of the numbers is going to be negative, right? All right, which of the following is true? This is an interesting question. Okay. Here's a way to think about it. Now, I want to know, remember the return is equal to return on some security. Well, I should put some. Return is equal to what? The risk-free rate of return plus beta, let's use the capital B, times the return on the market minus the risk-free rate of return. Okay, that's what we got to remember. The beta of a U.S. Treasury bill is 0. U.S. Treasury bills are what? The risk-free asset. So if I want my return of my risk-free to equal my risk-free, right? That I'll have to make this equal to this, right? The return on my treasury bill should equal the return on my treasury bill, not plus any of that. So for this case, the beta has to be 0. The beta of a treasury bill is 0. The beta of the market is 1. We know that. And yeah, the estimate of the beta is going to change because people might use different numbers for return on the market. They might use the S&P 500, they might use the Wilshire 5000, the Russell 5000, all kinds of different numbers people might use for these when they calculate the beta. But maybe this is the harder part to figure out. And that is, again, if I want the return, if I'm looking at a U.S. Treasury bill, I want to say, what's its return? I really want to say the return of my risk-free rate of return is equal to, my risk-free rate of return is equal to, not that. Well, yeah. Let's do it that. How do I get this equation to be true? Well, this is my treasury bill. Well, the only way I can get that is if this back part is 0. So the answer here is B, all of the above. All right, next one should go relatively quickly. $1,000 par value bond, 8% is paying 7%. It sold for $1,100. The price went up. If the price goes up, we always know the yield goes down. Right? Price went up, so we know it's got to be less than 7%. Why? Because if it's selling for more, that means the current interest rates are smaller. This is the interest on the 7% is doing better than the market. You can also put this in and calculate it, right? But you can just look at this problem and know. I mean, you could do a yield calculation, yield to maturity, or just a simple yield, and see that would be the case. All right, remember the yield is the interest payment divided by the price. All right. Interest on corporate bonds is typically paid what? Semi-annually, twice. Preferred stock. We talked about preferred stock. Preferred stock is equity that pays required dividends every year, forever. Forever is the key part, which makes it a perpetuity. Which of the following is true of common stock? They're not tax deductible by the corporation. That's true. Common stock doesn't mature. That's true. In terms of mature, the company issues stock, it never has to buy them back. Common stockholders are owners of the firm? Absolutely. And bondholders are creditors. They're owed money. So this one, hopefully everybody got. D. Beta. It's the relate. A lot of people talked about beta as a risk. It is sort of. But beta is really the relationship between investments returns and the market returns. It's not a standard deviation, clearly. It's not the total risk. It's not the idiosyncratic risk of the business. It's the relationship between investments returns and the market returns. And if you remember from the book, I think we talked about it here, it's the slope of the line of the securities market line. So that's that. Right? Think of it again on the beta. If the beta for the market is 1 and your beta is greater than 1, that just means your investment returns have to be greater than market returns when it goes up, or it's Not quite as bad when it goes down. All right, what do we got? Okay, we're considering investing in BKI. The firm's got a beta. Oops, looks like capital asset pricing model problem to me. Treasury bills yielding 6.75 and S&P 500 18.2. Required rate of return, or your required rate of return on your investment. Capital asset pricing model equals the risk-free rate of return, treasury bills, 0.0675. I don't want the risk-free rate of return. I'm going to use this equation right here. Oh, that was not good. Let me go back and do that. Sorry about that. I'm going to use that equation right there. So let's put it in. I want to have, it's the risk-free rate of return, 675 plus beta. Now I got to start using parentheses. Beta, because I want to have this done before I add the risk-free rate of return. So my beta, 1.62. That's my beta times, again, parentheses, the return on the market, 0.182 minus the risk-free rate of return, 0.0675. Close that parentheses, close that parentheses, and I should get 25.3. Right? If you're looking for places where you may have made a mistake, one might be parentheses. I always put in parentheses. I just don't trust Excel or anything. It also makes things clear. Here's the risk-free rate of return. Right? I got that. It's all in there. All right. All the following affect the value of a bond except value of a bond. Let's see. How do I calculate that? Present value. Well, I need a required rate of return. Assets. I don't remember that in the present value formula. Coupon rate. I need that to get how much I'm paid. Maturity. B. Again, value of a bond, present value. Simple way to think of it. Value of a firm's assets have nothing to do with the value of a bond in the calculations. Callable bond. Well, business can buy back its bonds. Well, why would it do that? Well, it would do it if interest rates came down, because then it could issue new bonds and pay less interest. That should be pretty easy. All right. 20. I bought a bond, bought some investment. Investment changed year after year. What is the holding period return for the year 2016? All right, there's a lot of numbers in here. But what is the holding period return? It's equal to the ending amount. Let's see, 2016. At the end of 2016 is worth 590. So minus the beginning amount. Oh, at the end of 2015 it was worth 535. Subtract that and divide by the beginning, 535. Don't want to do that, sorry. 535, and I should get 10.28%. Now, one thing to note is if I had gotten some dividends or interest in the middle here, I'd add that to the value, my ending value. I have to include that money, right? Because it did return it to me. Which of the following belongs to firm's stockholders? Limited liability, ownership. Yep, looks like all of them. You invest $5,000 in a Roth IRA each year. You put your money in the S&P 500. Good for you. You expect to return 7% annual. How much will you have in 30 years? Looks like a straightforward future value. Future value of my rate is annually 0.07. Number of periods, 35. And my payment each year, I'm going to put in minus 5,500. And I have no present value. I'm not starting with any money. So how much will I have in the future? $760,000. All right. By the way, that at least used to be the maximum you could put in your Roth IRA. Now it's gone up to $6,000. So if you'd started that and you're 25 years old and at age 55, you'd have $750,000. If you had a higher interest rate, you'd do even better. Let's just take a quick look at, fix this so you can see it. But if you had an interest rate of, say, 9%, which is more like the stock market is averaged, you'd have over $1 million. The lesson here is put that money into the Roth IRA at age 55, over $1 million. Okay. If a bond has a Standard & Poor's rating of BB or below, it's referred to as junk or high yield. Why are these called high yield? Because they pay a high rate of interest. Why do they pay a high rate of interest? Because they stink. I shouldn't say that. I should say that they're risky. Sorry, I got a little distracted here. Got to see an Amazon truck parked out front. Amazing the changes that are going on. All right, which is following is true if interest rates rise. If interest rates rise. Let's think about that. Short-term bonds will decline in value more than long-term bonds. If interest rates rise, what that means, well, again, to think about this one, you need to think about what happens over time. We had that question kind of earlier. How does the future value or the present value change relative to interest rates? Well, if interest rates go up, that means I'm discounting the present value of things out in the future become less. And the longer I go out in the future, the more those will decline in value. Let me see if I can try that another way. In value. So we're talking present value. The value of a short-term bond, I have to discount by the interest rate. Okay. Same thing with long-term bonds. But if interest rates rise, then the longer the period, the more I have a decline, which means long-term bonds decline in value more than short-term bonds. Now we're getting into questions. This one, stock valuation. How do I value common stock? Notice in this one, the little trick you paid, the formula here is going to be what? The price is equal to dividend next year divided by where are we here? Required rate of return minus the growth rate. So return minus the growth rate. Okay, so the little trick in here is going to be this D1. How do I calculate the next year? Again, use parentheses, please. So it paid last year 2.25, but now it's going, what happened there? Oh, sorry, 2.25, but now it's going to be bigger next year, 1 plus the dividend growth rate, 0.025. That's my dividend next year. Again, notice the parentheses. Divided by required rate of return, 0.145, minus the growth rate, 0.025. I get 19,281. Simple preferred stock is similar to a bond in which way? Well, they don't have the same maturity. Both investments require a fixed income stream? Yep. Both stocks have growth factor? No growth factor. Preferred stocks don't pay interest. This one's got to be B. I'll get that one up. Okay, minimum rate of return necessary to attract an investor to hold is, well, of course, your required rate of return. If you put rate of return, I think I gave you credit also. Bluto preferred stock is a 5% stated dividend payout and $100 par value. What's the value of, if your required rate of return is 6% per year? The value, all right, we know that. That's the price is equal to what? The payment, the dividend payment, divided by the required rate of return. That's the formula, so let's do that. The price is equal to dividend payment. Well, how much am I getting paid? I'm getting paid 0.05 times 100. I divided that by 0.06. What did I do wrong? Oh, shoot. I keep hitting the 8th instead of the shift. All right. 83.33. Again, if you use the round function, it'll drop all those others off just right. Next one, Zamperini. Oh, anybody know where I get some of these names? Zamperini. If you've never read the book Broken or Unbroken, oh man, you're missing. Louis Zamperini is one of the most amazing true stories you'll ever hear. All right. Louis Zamperini. Assume that had an outstanding issue of 15-year, $1,000 par value bonds, place interest semi-annually. Ouch. 2 times a year, right? Further assume today's required rate of return is 9%. How much would these bonds sell for today? Present value. Sell for today, present value. The rate. The required rate of return, 0.09. That's an annual number. I got to divide it by 2. Remember, anytime you get this semi-annual, change the rate, change the payment, change the periods. 15-year. 15, but it's paid semi-annually, so I have to change that one. Payments. Oh, what's the interest payment on this sucker? Interest payment, it pays 0.06 times 1,000 but it pays it semi-annually. To divide it by 2. Now, in this case, it really doesn't matter where you put the divided by if you know the arithmetic of those things, but oops. And it has a future value. So it's going to pay me that, and it has a future value of $1,000. Right? What do I get? 755.67. Now, it's not really worth a negative amount, so I would go in and put the negative in front. All right. Again, the trick, if there's a trick in this one, is to know, yikes, is to know that you have to change the period, the interest rate in half. The number of periods has gone up by 2, and here, indeed, the payment is half. All right, systematic risk is, well, it's not diversifiable. And it's the risk from, we can put it risk all businesses share. No, that didn't work out very well, but here, now you can see it. All right. Not diversifiable risk that all businesses share. Idiosyncratic risk is risk unique to the firm. Hopefully most people got those. All right. You analyzed an investment and conclude there's a 10% probability. All right, so here we go. This is expected rate of return. We're going to see a bunch of these kind of flavors, but expected rate of return, oops. Let's put that one back so my numbering goes right. Sorry. Equals that one. All right. Expected rate of return equals, well, it's the probability of each return times the return and add them up. So of a 10%, use decimals, 10% probability of negative 0.10. What happens? Negative 10 times a negative 10%. Time, plus, all right, so that's this probability times that return, a 20% probability of making 5%, all right, 20% times 0.05%, parentheses, so important, plus, what else do I have? 40% making 20%, 25%. 0.40 times 0.25. Now, when you do this, before you do this, you ought to just eyeball it and you say, okay, I could lose 10%. I could make 5. Oh, I'm missing one. I got the 30%. %30 of make times what? 10%. All right. You ought to kind of eyeball and say, what do I think I'm going to make? What is it going to look like? I could lose 10. I could make 30. I could make 40. No. Lose 10, make 5, make 10, make 25. Yeah, I'm guessing it's going to be somewhere over, it's going to be more than 10, right? 13%. If I got a number that was, here's ways to look. If I got a number that was greater than 25%, I know it was wrong, right? Because none of the other expected values are greater than 25%. If it was less than 0, I'd probably, if I was losing money, that's probably wrong because I only have a 10% chance of losing money. So it helps to eyeball these things and just to see that you've got it right and you're not missing something. All right. In finance, risk is most often measured using the standard deviation, not beta. Beta gives you an idea of how the market how the performance of a security works relative to a stock, but not really risk. And although I marked it wrong, when I added all these points at the end, really shouldn't have to worry too much about that one. Your friend needs to borrow money and they say we'll pay the following months over the next 10 years. If your required rate of return is 8%, how much are you willing to lend? Okay, how much am I willing to lend? So that's money today. Now, how do you do this? Well, you can do it the hard way. Take the present value of that, plus the present value of that, plus the present value, present value, present value, present value, present value, present. And you could do that. Or you could say, hey, there's $50 sitting in all there. Let's try and use that. So let's do that. Let's say it's equal to the present value of, what's my required rate of return, 0.08. And how many periods am I looking at? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 10 periods. I have a payment. I paid $50. And the future value is 0. So that's part of it. So this is the first part, all these 50s. But I still got another 500 here and 1,000 on here. Well, I did take care of 50 out of this. So I want to take the present value of what? 0.08. And how many periods out is that? 1, 2, 3, 4, 5. 5 periods out. Payment is 450. And the future value is 0, so what happened here? What did I do? Payment, number of periods, payment, 450. What did I do on this one? I think I put a negative there, right? All right. Ooh, what did I do? Present value, 450. So something's wrong, right? Obviously, did something wrong. Because my present value can't be bigger than $450, it's got to be less. What is going on here? Present value, 0.08. That's my number of periods. Let me rate 5 periods out. Oh, it's not a payment. That was stupid. 0, comma. There we go. No payments. I just get the 450. I don't have payments. That was dumb. All right. Let's make another bad mistake here. Equals present value. Now I take this last one out here, 0.08. Number of periods. It's 10 periods out. No payments. I learned from the last one. And it's not 1,050. It's only 1,000. And I've been using negative numbers, so let's just use negative there. And so how much am I willing to pay? Well, it's the present value of that, plus that, plus that. All right. Well, again, the importance of eyeballing stuff. I knew that the present value of this wasn't going to be more than $450. A debenture bond. Simply corporate bond, no collateral. By definition. Government bond for a project that will increase revenues. It's a revenue bond. This is a secured bond. Got the terms in here already, right? Revenue, secured. And this is a callable bond. All right. You deposited $100 a month. We're almost there. $100 a month in an account earning 5%. How much money will you have in 10 years? Simple future value. Equals future value of the rate. Now I'm going to keep deposits. So now I'm going to want a payment. Number of periods, 10 years. And the payment is minus $100 because I'm putting it in. And I'll have $12.57. All right, well, I just looked at my answer sheet and I noticed that I had this problem designed to be how much you would earn if the interest was compounded monthly. So I probably marked yours all wrong, but consider that as part of the gift of the 20 points I added to everybody's exam. Onward. Kvoth. Another good name. It's from a book, The Name of the Wind. Oh. All right, they have 17 years to maturity. What is the yield to maturity? Yield to maturity. So I want to know the rate. This is going to be fairly, rate. Yield to maturity. Rate. 0.06. It's payable annually. I have to be careful with the bonds if they were semi-annually, but this is okay. 17 periods. Present value. Currently sell for. So if I paid $850, gotta make one of these negative. I pay $850. What do I get? 6%. 0.06 times 1,000. And I get a future value. I'm going to get 1,000. And so I'm making these two positive. I'm making my payments and my future value because I'm getting these positive. I have to pay that. So I'll make that a negative. And the yield to maturity should be a bad number. Why is that? 7.06. Yeah, why did I do that? Well, I got these numbers mixed up. Sometimes it's good to see bad mistakes in here, right? The present payment, see, I switched around the payment and the present value. Now I switched around all these numbers. Whoa, man, asleep at the wheel. It helps to take a look at this. All right, 17 periods. Let's redo this. The payment is 6% on 1,000. Present value, I have to pay out $850. And the future value, I also get 1,000. All right, so 17 periods. I don't have to worry about the semi-annual. I get paid 6% on the coupon value. I get that. Today, to buy that bond, I have to pay $850, so that's negative. And in the future, I get 1,000. Now, what did I do wrong? How can I be missing another parenthesis? Oh, I got too many in there. 8%. All right. Phew. I'll copy that one. Okay. You want a 15-year mortgage, and the annual rate is 6%. Mortgage payments are monthly. There we go again, 12 years. How much is your monthly payment? Monthly payment. That sounds like a payment problem to me. Payment of rate 0.06. Oh, that's pretty high these days. But that's an annual interest rate. So if I want to know each month, I divide it by 12. 15-year mortgage, but I'm working in months, so I have to have times 12 months. Present value. I want $300,000. So I want to be given $300,000. Future value? Nothing. That should be it. I'm going to get a negative number. Put that in front. And again, to Adam's question, what do I do if I make a down payment? Well, my down payment means if I have a $100,000 down payment, then I also take out this $300,000 mortgage. I can buy a $400,000 house with these monthly payments. Next. All right, we really are nearing the end. So, Crew has a preferred stock selling for $38 a share, pays a dividend of that. What's expected rate of return? Remember, this is the perpetuity. We talked about this before. So it's my dividend. Oh, expected rate of return. Yeah, it's perpetuity. I just flip it around. Basically, it's the yield. So it's the dividend. 3.25 divided by the price. 38.50. Done. Expected rate of return 8%. Again, if you're getting like 30 or 40 or something like that, you know you're just off in terms of. Let me copy this one down too. All right, Nelson Common Stock pays $1.32 in dividends, expected to grow 7% annually. What if you require 11% return? That's just like one of those other ones we worked up there. Equals, value is equal to the dividend next year. So it's 1.32 times 1 plus what? 0.07 divided by 2. My expected rate of return 0.11 minus the growth rate 0.07. 35, 31. All right, Smith & Jones. Common stock sells for $23. The company expects a constant growth rate of end of year dividend. What's their expected rate of return? All right, and this one you had to remember the expected rate of return is equal to the yield of the stock, dividend yield, divided by not divided by, dividend yield plus the growth rate. So my expected rate of return is equal to, my dividend yield is equal to, I expect the end of the year to be 2.50. My yield is the stock, 23, plus the growth rate. Again, use parentheses. The growth rate, big growth rate, 0.105. 2136. Your computed common stock's return is 15%. Your recorded return is 10%. What should you do? Hey, if I want 10% and this one gives me 15, I better buy the stock. Right? That should be straightforward. Finally, the beta. This is actually in your homework. How to calculate the weighted average beta. What you need to do is calculate here what percent each stock is of your portfolio. So you have 165,000. So let's just take stock, the amount, the value, we'll say, beta. So I got stock A. Its value is 165,000. Beta is 1.25. I got a stock B, whose value is 85,000. And the beta is 2.35. And I got another one, C. So it's 235,000. Whose beta is 1.11. Now, before I do any calculations, the beta of this portfolio is not going to be less than 1.11, and it's not going to be greater than 2.35. I know it has to be in that range. The beta of my portfolio can't be bigger than the beta of the market or less than the worst of the betas in these. How do I calculate that? Well, first what I need to do is see how much is total in my portfolio. My portfolio, add these guys up, $485,000. So now I say, well, what percent of the portfolio is this? It's equal to that one divided by the total. It's equal to that one divided by the total. And this one's equal to that one divided by the total. If I add these up, it should be 100%. It is. Now what I do simply is calculate the percent of the portfolio times the beta. And then I add them up. And there's my weighted average beta. Okay. So I calculate the percent, and this is the beta times the percent. And I add them up, and they get my weighted average. Anytime you want to do this, you always do weighted things. It's just like doing your expected return where you have the probabilities. And we're going to do more of these. You'll find other cases where you have to do weighted averages. All right. Well, that's the exam. I hope you understand all the questions. If you have any questions on any of these, absolutely ask. I realize on the one question I made a mistake, but also on this exam I gave you a lot of points. So that should all work out. All right, we'll see you in the next live conference.